Welcome to our YouTube video series on incorporating a business. My name is Christopher Neufeld of Neufeld Legal. And in this particular video, we'll be discussing the 5 primary reasons for incorporating a business as a company. Now, the 5 reasons in brief are 1, limited liability, 2, tax savings and deferral, 3, income splitting, 4, lifetime capital gains exemption, and 5, estate planning. Now let's dig into each of these individually. Number 1, limited liability. The concept of limited liability is that the corporation is separate and distinct from its shareholders. And as such, the debts and liabilities of the corporation are specific to the corporation as a legal person as opposed to its shareholders. And as such, if somebody sues the company, they're limited in suing the company and not in suing its individual shareholders. Now, this might well work in many instances, but it's not an absolute. So from a legal perspective, there's a couple things. Number 1 is even though there's a corporate veil, the corporate veil is known to be broken by judges in certain circumstances. Oftentimes, when there's involvement by the shareholders in advancing something that was improper, then the courts have gone about to break the corporate veil. Also, there is the issue of directors and officers' liability. So when you're the operating mind and operating decision maker, you make decisions that impact adversely other people, you can still be sued for that as an officer and director of the company. And finally, there's the aspect of contracts, whether it's bank contracts, franchising contracts, real estate contracts. Those typically recognize the limited liability of corporations, and to make sure it's clear, they get personal guarantees and indemnifications from the individuals before they advance their property or they advance money. So it's not an absolute. It does provide a degree of protection. The protection is preferable to operating as a sole proprietor or operating in a partnership, but it is not absolute. The second aspect is tax savings and deferral. Now, first of all, we have corporate tax rates, which for small businesses in particular, those operating in Canada as Canadian-controlled private corporations, there are substantial tax savings to be achieved, at least until you take the money out of the corporation for personal purposes. There's a balancing that goes on with respect to personal tax rates when you operate in non-corporate business as opposed to when you operate in corporate business, where there's a bit of a correction and fluctuation, so that if you're not immediately needing the money that you're generating from the company, or alternatively, you reinvest the money to make more money, you're going to have the benefit of the lower corporate tax rates. And this is going to be far better for you from a long-term perspective. So if you take the lower tax rate as a corporation, reinvest the money, you're going to be far better off than if you were in a sole proprietorship or a partnership where when you earn money, you're going to be taxed on it at the personal tax rates, something you want to try to avoid if at all possible. But it really depends on how the business operates and is structured. The third concept is income splitting. Now, income splitting used to be a very prominent reason for incorporating businesses, especially small businesses, where you could shift money to lower income spouses, even children, subject to these kiddie taxes and alternate taxes they had in place. But with regulatory changes, the government tried to downgrade the amount of income splitting that could be achieved from a corporation, so that you need to be making a sufficient contribution towards the company to be entitled to receive income from it and to get the benefits of the corporate tax rates and the income splitting opportunities that are available. So you got to be careful about this. not over assess it, understand it, and look at it with an accountant to properly understand how to do what limited income splitting is permissible. The fourth reason is the lifetime capital gains exemption that is provided to owners of Canadian-controlled private corporations, and otherwise known as CCPCs, and this is most small incorporated businesses in Canada, where they are allowed to have tax-free capital gains up to a certain number that is increasing year over year. So as of this recording, we're somewhere in the high $800,000 range to $900,000 range that of capital gains that you're allowed to attain tax-free. Very important aspect. Then again, you must understand how to properly access this, and you have to structure any sales to properly take advantage of it. So once again, working with both the lawyer and the accountant, you need to put this properly into place so that you can take full advantage of it. And this is something that is not necessarily available with other structural arrangements. And finally, there is the aspect of estate planning. Now, estate planning allows you to allow the company to flow on to your successors and your heirs in a manner that might not be possible where you have a sole proprietorship or a partnership, such that having a corporation can be advantageous in the long term to allowing you to flow and to develop the business and pass it on to successive generations. Naturally, the business has to be successful, and naturally, the structures have to be put in place to allow for this to happen. And as with most things, it's critical that structuring take place and that you properly protect and insulate the company, especially when you have a multi-shareholder structure. Hence the need for a unanimous shareholders agreement and other controlling documents and arrangements such that you don't find yourself in unnecessary litigation internally or unnecessary problems internally that devalue the company and offset the benefits that you're looking to achieve through incorporation. And that is best understood with the guidance of knowledgeable legal counsel. Thank you.